this, right? Okay, you guys can read up on that. Also on the website, carries a certain level of risk and may not be suitable for all investors. Past performance is not indicative of future results. Okay, you guys know the flow. I won't go through this again. Right, the advanced indices session today. Right, now what is an index? Okay. Some of you have attended the previous session that I actually did on the indices, the introductory part. Now, index trading is a type of trading of group of stocks. Now, this is a more technical term, which make up the index. So that basically means you'd have all the top 200 or 100 or 50 companies within a certain stock exchange, right? So all the companies that are actually listed. So let's say in the US, you'd find your Apple, you'd find your Procter and Gamble, let's say your JP Morgan, all these large companies. I'm not sure if Samsung is Singapore or something like that, I'm not certain, right? But all of these large companies and that are performing well, the top 100, based on market capitalization, right? Now, a number of them, of these are based, so they basically are based on the stock prices. Okay. Now, you'd have an example of the S&P, which is the Standards and Poor. Okay, Standards and Poor, the 200. So that's the 200 companies bulked up and basically made into one index. So you can actually trade them. Right. Also, you have your FTSE 100, which will be mainly what we focus on in terms of the actual strategy that we're going to be using. The FTSE 100 is the top 100 companies in the LSE, which is the London Stock Exchange. Right. So all the companies that are listed there, the top 100, make it onto the FTSE 100. So they make up. So you sort of like get the premium market. So instead of you trying to pick stocks, all you do is buy a piece of an index, and then you have like all the top performing companies. So you don't really have to do a lot of stuff of research. And the CAC, which is France, and the AEX, which is the Amsterdam, and the DAX, German DAX, which is the top 30 companies in Germany listed. And you have the IBEX 35 and many more. There's NASDAQ, there's Dow Jones, all of these. Some are for techno companies, so technology companies rather, would make up perhaps the top 30 or the top 50. Yeah, I think that's the top 50. But we'll get into that. What you're going to be focusing on though rather here is the FTSE 100 and also the German DAX. Those are the two ones that have a high accuracy rate when it comes to the actual strategy itself. Right. Now, a lot of professional traders only trade indices because of its liquidity. Okay, it's a very liquid market, not as liquid as foreign exchange, but there is a certain level of liquidity. And plus, you find some people just only trade in indices. So that's one index. They know all the news, they know all the stuff that goes into that. Now, indices generally go up. So even long-term investments in indices are a very powerful strategy. I'll show you guys a chart now. The reason being, an index is made up of the top performing companies. Even if you go through a recession, some companies will still be going strong, right? So Apple, all through a recession, will actually head upwards, right? And so what happens is if you have 30 companies listed on the index, and all those 30 companies go bankrupt, right? What happens is the bottom 30 companies or the preceding 30 companies that will beneath that will be taken and make up the German 30 now from now on. So that simply means it's more of a performance game. So you always have the top 30 companies in Germany if you're buying the German DAX. So if number 30 falls and goes bankrupt, for instance, right, the 30th company on the index goes bankrupt, what will happen is the next company based on capitalization will just come in and fill in that spot, right? So the index will probably never ever go to zero, right? Because if it goes to zero, that simply means that all companies are worth zero. You get me? So that's why it's a long-term strategy as well I use, in terms of investments and stuff like that. All right. Okay, now this is a chart. I hope it's gonna pop up. Okay, this is a chart of the UK 100. Right. So the UK 100, the UK Financial Times Stock Exchange, which is the FTSE, basically houses the top 100 companies in London. Right now, this is a monthly chart, and as you can see, since 2011, the market has just been rising. And what you're going to need to do is, because I don't really have a lot of data on this platform that I use, but you can go back as far as you want to go. You'll see what I'm talking about. It's just up and up. It doesn't really go down. Now, in areas where it does, these sort of pullbacks, that simply means that the market, the overall actual economy was doing bad at this particular stage. All right. But if you hold on as an investor in this type of movement, you will eventually edge higher, because in general, things are getting better, new innovations, companies are growing. So that means that as a general rule, indices will invariably go up, right? Even though they might have some very scary pullbacks for most. Okay, now first concept that we're going to get into is actually counting candles. Right now, what would happen is with okay, let me get my marker. All right, so what would happen is you guys should know you have red and green candles. Right now, these red candles obviously depict a downward moving market, and the green candles depict a upward moving market. So that's your bullish moves. Right, so when you're counting candles, what you simply do is you literally count the red candles. Right, so in this example, you have 1, 2, 3, 4 red candles, okay, in a row. Right, over here you have 1, 2, 3 green candles going upwards. Right, and here you have 3 going down. Right, now the concept of actually counting candles is based on pullbacks. Right, the market doesn't go straight down, it drops, and of course we have a bit of a pullback to clear out all the stops, and the market continues to move to the downside. Right, so it doesn't drop down to hell. It needs to offer those pullbacks, which is what we mainly going to be maximizing on or capitalizing on. Rather. Right, so that is the concept of counting candles. Now you're looking for red candles in this example. I'll tell you guys a bit more about that when we're actually looking at the ideal trade setup, but look for candles in sequence, right? So if you have 2 candles like you had here, this is your 1, 2, then this invalidates the third push, right? So we expect, or we'll be looking for 4 candles going down, 4 red candles going down, and if you'd had perhaps this as a green candle going upwards, this would have restarted the count. So this would be 1, and then 2, and then 3 again, 4, and then obviously the entry will come in once I've clarified everything for you. All right, so everyone is still on the same page. Still good. Okay, awesome. Okay. All right. Now the tool that we're going to be using here is the Bollinger Band. Guys should know it's sort of like the TDI volatility band. Okay, the actual TDI volatility bands are based on Bollinger Band. I think they're developed by John Bollinger way back when, and essentially what they measure is deviation from price. Okay, now as you guys know, the squeeze, okay, the Bollinger Band squeeze is based on the volatility band squeeze, and when the market opens up, we have a increased volatility. So that means there's a lot of activity within the market itself, right? So now, as a general rule, the middle of this, okay, this is sort of like the baseline, and The higher band, the band above is your resistance level, and the lower band will be sort of like your support band. Okay. Now, as a general rule, what we have to know is the market will move at the baseline itself. Okay, the middle of the band. I just call it the baseline. It's not called the baseline. I think it's called the middle band, but I just call it the baseline. And when the market is at baseline, it usually depicts that things are chopping sideways or not going in one particular direction aggressively. Right now, when the market then opens up like this, that depicts increased volatility. Okay, increased volatility is measured by these bands, and so they will expand. Okay, so they're going to expand, telling us that a huge move is starting, or there's a lot of movement within this actual part of the market. Now, with this choppy sideways movement and the breakout, this forms our support level, right? So we'd expect the market to bounce off here. And this high of the band is our resistance level. We'd expect the market, once it gets here, to bounce off and pull back into the zone, right, into the middle of the band. Because the majority of the time, the price action will be at baseline, right? Okay, now with the Bollinger Band, what we'd expect is sometimes the market will break outside the band, right? So this is the Bollinger Band break. I'll try and draw it as, this is the actual break of the Bollinger Band. This means that the candle closed below the support level of the Bollinger Band, right? And you probably have, this is incorrect, but second candle break below it. All right, I'm running out of space. Let me do this. Let me start off here. Okay, so let's say the market has been consolidating. Now you're looking at this being your first red candle and your second red candle. Then you have your third red candle and your fourth red candle. Okay, now all of these candles actually broke the low. That means that the market was aggressively moving to the downside. As we know, an aggressive move is usually the false move, right? And the slow, relentless move is usually the true trend. So you have these four candles, each breaking the support level, the Bollinger Band support level, right? So when the market is quiet, it will move in between here. So this is where you're going to get your candles. I'll show you guys in an example I did. And once the market breaks out, it will open up the band. But if it's too aggressive, it will close below the support or the resistance level. But now we're just going to be focusing on the actual support level because that is what's going to give us those entries. Okay, everyone's so good. Same page. Nobody's lost. Okay. All right. Okay. All right. So now this is a very simple strategy, like I mentioned. Now these are the actual rules. These come part of the rules, and I'll just go through them with you guys so you'll be able to formulate some sort of a trading plan based on this. All right. Now you can only take a trade on the H1 and daily time frame at any time. All right. Meaning anytime if you're looking at the charts and you see an actual setup, you can place it at any time on the 1 hour or daily time frame. So you only look at one time frame. You don't look at the 4 hour and then look at the 15 minutes, and you're only looking at one time frame. It will be probably the H1, which is the best, but you can look at a daily time frame. But I'd rather you not do that at this point. Just try and focus on the daily time frame because that's easier. Or you can use the 15 minutes at the market open. Right, so when the market actually opens for trading, because indices do close, unlike forex market where you have a 24-hour market, they will in fact close, and when the market opens, it might gap up or gap down, right? So there might be a gap. That's why you have a lot of gaps in indices, whether it be your German DAX or your FTSE 100, whichever one that you're going to be trading. Right now, you use only 15 minutes at the market open. Right now, depending on which broker you're going to be using, times might be different, but it's usually the London. Okay. Okay. It all depends on the one that you're going to be trading, because for the German DAX, obviously, it's going to use German time. So when their 8 o'clock strikes, you're basically going to be trading that time. But for London, it's obviously going to be during the London session when they open the stock exchange in London, LSE. Right. But I'll share with you the times near the end, so you can write all of those down. But like I said, guys, I preferably like you to trade the H1, because once you sit on the 15 minutes at the London Open and just don't see something that's quite developing, you tend to actually try and force it, because you might have woke up early and you try. So on the H1 time frame, I mean, you can look at it at any time. Right, so as soon as you see at least 3 red candles going down, break up below the Bollinger Bands, then you're simply just waiting for that confirmation candle. I'll show you guys how to actually confirm an entry. All right, now, first of all, we don't have pips. We only use points. Okay, now points are essentially the same as pips. However, the only difference is when you're buying an indice, what happens is there's an actual price that you buy at, right? So right now, let's say the price is at 7,500. So that means for you to actually purchase one part, okay, of, it's sort of like a share in an index, you are basically going to need 7,500 pounds or 7,500 euros, okay, to buy one part of it. Okay, those are a bit more, it's a bit more expensive to actually trade the indices as opposed to your forex, where you have your micros. So you can only take one contract, right? So you're going to buy one contract, and that contract you're not going to be holding for long, right? Now you enter with a 20 pip or 20 point stop loss and a 10 point take profit level. Okay, now obviously the risk reward is not that good when it comes to this particular strategy. However, with 90% accuracy, over 90% accuracy, it makes it very worthwhile for you to actually consider the strategy, because it's very difficult not to actually get that 10-point pullback, to be honest. You guys can go through the charts and do your own back testing before you open up a demo if you want, and you'll see that it's very hard not to actually hit 10 points. Now that's not a lot. Okay, so sometimes it might go for 100 points, 300 points, and you only took 10 points. But the only thing that you're trying to achieve with this is that consistency, and obviously the accuracy, keeping it above 90%. Right. Now we're only looking for buy opportunities. You're not going to be shorting any of the indices. So if you're trading the UK 100 or if you're trading the German DAX, you will not be shorting those markets. Okay. As with the actual reason why I spoke to you guys about earlier on, so I did mention that as a general rule, an index will edge higher, right? So it will go higher, and the pullbacks that you are going to get aren't trend moves down, they just pullbacks, right? So you don't want to be trading pullbacks, you want to trade in line with the overall trend direction. So you're only looking at buy opportunities. Now that also helps in the actual accuracy of the strategy, right? So I think that bumps it up from, I think it could have been like 80%, but it bumps it up at least another 10, 11, 12%. Now, you're going to need to design the trading plan around these rules, as I mentioned, and this would be an ideal setup. Okay, now you're looking at the H1, so you can visualize this. Looking at the 1 hour time frame, the market breaks below the Bollinger Band, and you count 1, 2, 3 candles, and the fourth candle is your entry point. All right, now you don't really have to look at or wait for confirmation candle go in the opposite direction. You are just going to enter at the close of that particular candle, especially on the fourth one. And if the market extends the Bollinger Band break by 20 points, you don't even wait for the candle to close. You just jump in. All right. Okay, now this is the ideal setup that I've been talking about. So if you're looking at this example over here, you have that break below the Bollinger Band. Yeah, so you have your close below the band, close below the band, close below the band, close below the band. So you have 1, 2, 3, 4 red candles going down. Right. Now, on the close of the fourth candle going down, you're looking for 10 points heading upwards with a 20-point stop loss. Okay. Now, with this setup, with this actual setup, guys, you can, your 10 points would probably be somewhere in here, but with the actual sizing, it will make it worthwhile. So you're probably looking at, I don't know, $100 on the move, and the stop loss will be probably like $200. It's also going to depend a lot on the leverage side of things, which I will be doing again, because I have a video recorded regarding the actual trade management and how to know what sizing to actually use. But what you can do, just keep your sizing constant. Trade the minimum, obviously, which is standard contract, which is 1 contract. That's what you're going to be looking for. And so with this 1, 2, 3 push to the downside, right? This is a break below, close, and then break below, close, break below. Now, the extension part that I spoke about, you see the candle broke below. Now, if when you measure from this break extending to where the actual market price is, let me just clear things up here. Now, when the market breaks below here, because we know that the market peak low was over here. So when this happens, let's say this is extended by 20 points, right? So from here to where the market is right now, it extends by 20 points. You can enter just there, right? So if you've counted your 1, 2, 3 candles, and they've all been bearish candles, the fourth one is your entry. Now on the third one, you can enter on the third push, but the highest probability one is on the fourth candle. They will make a pullback at least to about 20 pips, 20 points. But we are actually looking for now 10-point swing in your direction. Take profit, hit, you're done for that particular day. Now, the reason why I say we're going to be trading 2 indices, because on the FTSE, you might not have an aggressive day. You might not have any moves for that particular day. And perhaps on the DAX, you might find something. And this is applicable to all indices. All right. I don't want you guys going too far away from what I'm talking about today, which is the FTSE as well as the German DAX. All right. Any questions so far? Any questions? Is everyone good? Okay, all good. Okay. Right. So now, like I said, guys, in terms of All right, now in terms of analysis, you're just looking at the H1 and the daily time frame. You're only going to be using one time frame. Right, so if you choose to use the 1 hour, you're just going to be looking at the 1 hour. Right, you don't reference to the higher time frames, all of that stuff. You're just looking for a buy on the one time frame. So if you're looking at the daily, which I don't suggest at this point because you're not going to really get a lot of entries or a lot of really strong signals. So people tend to make up things when it comes to the daily time frame. Rather stick to the H1. You are going to get 2 or 3 out of 2 indices. You are going to get 2 or 3 good setups over there. Right. So we look strictly at one time frame. You don't reference to others. You don't look for an entry point. Just one time frame, 1 hour for now. And obviously, with a bit more experience, you can move on to the daily time frame or the 15-minute time frame as well. Right. So just as a standard base, it's very easy to trade it on the H1. Okay. Right. So as you guys can see, after this initial move out, then the market came in to the market baseline. Right. So as well to the upside here, and then it came back into market baseline. Now we're not going to be doing these sort of entries just as yet. So now we're just going to focus more on these break below the support level or the break above the resistance level, right? But we're not taking shorts over here. So this is a no entry zone for us. We're looking for that support to get broken, right? Now, the reason why I really share the strategy is because it's really straightforward. There's no ambiguity or uncertainty of should I do this, should I do that. It's clear cut. You're looking for 4 candles right below that support level on the Bollinger Band, and you buy 10 point take profit, 20 point stop loss. Right? There's no arguing with that. As opposed to, okay, let me see if I can shift here. 40 points, 10 points, really clear points. It's really clear, sorry, in terms of the actual rules themselves. So what I want you guys is to actually take down those rules and just revise them and have them printed up somewhere if you are going to be trading indices. Now, like I did mention, you're going to have a highly leveraged account. Right, so you're going to need, obviously, if you're going to take a $500 account and then you just use a leverage of 1:50, you really won't be able to actually maximize on it. You might need require higher leverage margin. So you might be looking at least 1:200. You can go 1:500 in terms of leverage. And if your broker applies or does give it to you, you can even use 1:1000. Right, but obviously only once you've done paper trading. All right, so what I'm going to need firstly is for everyone to open up a demo account that is strictly going to be just for trading indices. Right, so you can do that with FX Open. I think they do have it, but it's only on the ECN account. STP's account don't have it. So if you already on FX Open, just open that up. Guys on Hot Forex, I think there's guys on Hot Forex as well. But just take note that on different brokers, they might label them differently. So you might have GER30, that stands for the German 30, that is the German DAX on one broker. And then on another broker, you might get it as DAX30. All right, so it's either it's UK 100 or it's FTSE 100. Okay, that's the FTSE 100. Okay, so please just mainly focus on those two for now. Obviously, you can expand, but this is a very simple and straightforward strategy. That's why once you do it properly and consistently on paper trading, you're just going to be getting those 80–90%. Anything less than 90% is really not sufficient for the strategy because, I mean, you're just looking for 10 points. So it's really essentially a scalping strategy for people who do have the time, right? But you can even do this on your phone as long as you'll be able to to what do you call this? Set your stop loss and take profit levels. Right? So we used to use an OCO order. One cancels the other order, but you can use a normal take profit and stop loss for you because it does essentially the same thing. All right, because I don't think those are offered anymore. All right, guys. Okay, everyone is good. No questions. Okay, so please just open up that demo and just open up those two um, charts. So you're going to have your German DAX, you're going to have your UK 100. Now you're going to insert the Bollinger Band, no other indicators needed. You're going to drop down to the 1 hour time frame. Right, so you're going to go through to the 1 hour time frame, and what you're going to do initially is just, you find the Bollinger Bands and indicators. It might not be labeled Bollinger Bands depending on whether it's MT4 or MT5, but it's called bands. If it's not Bollinger Bands, it's called bands. You don't change anything in terms of the settings as well. Just keep the default settings and everything should be fine. So you're just looking at that high volatility movement, and that's the best indicator for me to actually measure volatility, the Bollinger Band. All right. Okay, good. Okay, so like I said, guys, in terms of the actual times themselves, it's during the exchanges. So normal times, like when they, so let's say you are trading the J225, that's the Asian. Okay, that's the Japanese. So what would happen is when the Asian session actually opens, that's when the J225 is also open as well. So if you're talking the UK 100, okay, when the European session opens, that's when the index opens as well. Right, so it's going to be different for each actually market, but as a general rule for that local market. So even here, because in SA we have that SA top 40, that only opens when the JSE actually opens. I think it's at 8:30 or something. All right. Okay, guys. So is that clear? All right. Okay, so if you guys don't have any other questions, probably just end of today's session here. Okay, it seems like you might be with me for the entire week because I'm going to be having that swing traders session because remember we pushed it back to Thursday. All right, and tomorrow we're just going to be doing that introductory to those options. All right, so you guys can just join through on that. Tomorrow morning, I'm not quite sure if I'll be able to do one analysis as well. It's just that running around home affairs and all that stuff. So I'll just let you guys know if I'll be able to do it. But I'll let you know around 8:30 or so. Okay. Okay. No, you've already done it, Tamara. Yes. Okay, it's for options. It's options class, binary options. Okay, no problem. All right, awesome stuff. Just practice this, okay? Take trades. It's like how you normally take a trade on with your platform. But what you're going to do, you can't actually get anything below one contract, right, on it. That doesn't mean it's just a standard. It's just one contract, and you're going to need to just increase on the leverage so you'll be able to trade sufficiently and have enough in that account to make it worthwhile for you. Right, so once you're done with the practice part of things, just let me know, and I'll let you guys know if you're ready to go live. Okay. All right. Thanks and guys for coming through. End of today's session. I did, like I said, I did drop off some stuff on the Telegram channel. I think it was yesterday. I haven't dropped off yesterday's session. I'll probably do that tonight as well as this session, so you guys can go over it. All right. Right, guys. Cheers.